One of the very surprising line items in retirement that could have an impact on your ability to pursue your retirement goals is taxes. If you don't account for these properly, your cash flow may not be what you need it to be in order to pursue this next chapter of life. So in this video, I'm going to share with you 5 specific things you can do to potentially reduce the impact of taxes in retirement. But before we get there, click on our subscribe button. I have over 30 years in this business, and I want to share with you what I know, the conversations I have with my clients, so you don't make the same mistakes they have. So one of the conversations that I have a lot with prospective retirees is the income they're going to get. Because in retirement, cash is king. The more cash we have, the more of the ability we have to pursue what we want in this next chapter of life. But one of the line items that they don't understand is it's not how much you bring in, it's how much you keep. And for some who have done some of the elementary planning or may not even done any planning at all, they just think about the top line number and then they get surprised when they enter into retirement. So I want to make sure you're not surprised. And that's why I want to give you those 5 tips that can help you to potentially reduce the impact of taxes in retirement so that you can move forward with more of that cash flow doing what you want to do. Now, I want to make it very clear here, I'm not giving you tax or financial planning advice. I want to arm you with enough knowledge, with enough of the questions, so you become more aware, so you can ask your tax advisor or your financial planner what you should be doing to keep more of that income. So the first item that I want to address is the issue of long-term capital gains. Now I want to take you to my screen for just a minute to try to give you some perspective on where we've been, where we are, and where we may be headed. So let's define what long-term capital gains are. So there are really 3 different categories. First, if you're married but filing jointly and your income is under $80,000, or it's between $80,000 and $496,600, or above $496,601. In the first category, your long-term capital gains rate is 0. In the second category, up to $496,000 for married filing jointly, or a single filer of up to $441,000, your long-term capital gains rate is 15%. And the top rate is 20%. So that's a little bit about where we are. Let's take a look at where we have been. So here we take a look at, and it's a little bit busy, but I think you'll get the gist of it. It's historical maximum capital gains tax rates. And I think the important thing to take away from this, and the chart is a little outdated, but it's still a good chart, and it still is relevant, that you'll see that historically we are at the lower end of long-term capital gains rates, where we saw an awful lot of the time previous to now, where long-term capital gains rates were much higher than where we are right now. Looking forward, there's a lot of conversation, discussion about having to raise tax rates for numbers of reasons. And I think that history will bear us out that over the next few years, in my opinion, tax rates will be going up. So this is a real consideration as we're headed into retirement. What do we do with those line items that have done very well, but we don't want to pay higher than we need to in terms of long-term capital gains rates? So there's 2 strategies I would suggest to you. If you feel like you really do need to sell them, my suggestion is to you to go to your financial advisor and tax accountant to see if now, right now, is the best time to do it. Because if you wait, and again, it seems that the predominance of the opinions that are out there is that tax rates will be going up. It may be more costly later to sell it than if you were to sell it now. The second strategy is, and again, go to your dream team of advisors, potentially marry up some of the losses you may have with your portfolio along with some of the gains. And in that way, you can minimize the impact of selling good investments and not having to pay more taxes than you should. The second item I want you to think about is if you wish to Roth it. I have a number of videos on our site here. You can go take a look at them here. But the Roth is a very interesting line item for you because your Roth, just like your IRA, the money can grow tax deferred. But two of the benefits that you have from the Roth that you don't have from a traditional IRA, you will not be forced to take out required minimum distributions at age 72. And the money coming out of the Roth is tax-free. So here is a way, and I talk about this a lot with our clients, in terms of diversifying your retirement accounts and taking more control over your taxes in retirement and your income. You have the ability, if you do it right, and if you incorporate a Roth, and again, I'm not telling you should or should not, something you should talk about with your dream team. But if you do incorporate a Roth, you do take more control over how much in the way of tax that you will pay and when you will get some income. There's another item that I want to share with you here with regards to the personal versus retirement accounts. And it's with regards to costs of the particular funds or investments that you own. If you own, let's say, a mutual fund, there are internal turnover or transaction costs that may mean that they are buying and selling lots of funds and they have to pass through those gains and losses to you. There may be capital gains on a long or short-term basis that you are going to be having to be accounted for in terms of your taxes. You need to be going back to your dream team and making sure that if a particular mutual fund is passing along to you high expenses in terms of transaction costs, or you're paying more taxes because they're making buys and sells and you're having to pay a lot of taxes as a result, you may want to think about owning that particular fund in your retirement account. And this is where the planning and your financial professional can help you out tremendously. The final item that I want to bring to your attention, and to me it's an obvious one, and I'm guessing to you it may not be, but it is just the planning. So when we have conversations with our clients, top of mind for many of them, one of the top 2 or 3 things is to reduce the impact of taxes. But it's just not as simple as that. I just want to reduce taxes, therefore, bing, we hit a button. It doesn't work that way. What we have to do is understand what your cash flow need is, where cash flow is coming from, what do you have for assets, what's in your bucket list, and then design the income faucet that's appropriate for you so you can take control of when you are getting the income and how much in the way of taxes that you have to pay. Planning is the absolute key to the reduction of taxes, and this is where working with a financial advisor in alignment with your tax person will help you to put you in a place to keep more of that income that you have earned.